Welcome to the Finance Podcast. The topic of this episode, identifying opportunities from the rise of artificial intelligence, with Martin Frandsen from Principal Global Investors.
I hope you guys can hear me all right, also in the back. Thanks a lot, all of you, for coming today. My name is Martin Frandsen. I'm a portfolio manager at Principal Asset Management. I manage the global strategies. We invest across a wide range of different opportunities, but one of the areas that I'm most excited about right now is AI and how that relates to opportunities across different sectors and across different industries. I'm going to talk to you about today how we try to identify investment opportunities from the rise of AI. That's going to be on the back of a white paper we're currently writing together with our real asset team. So that's a team that invests directly into physical data centers across the world. I'm also going to talk to you about how we try to evaluate different thematic opportunities relative to each other. So we've written another white paper on that, on a proprietary framework for evaluating specific thematic opportunities. And then we're going to try and go into details around what sort of opportunities are actually coming from the rise of AI. Most of you probably know NVIDIA, right? But in our view, there's a lot of different opportunities if you go across the value chain, across the supply chain, and we're going to try and talk about some of those opportunities today. The reason why this is important is that over the last couple of years, the rise of AI has been very significant, but also the investments into thematic opportunities has been very significant. Since 2019, the amount of capital invested into thematic opportunities has more than doubled. At the same time, investors have roughly only benefited from around 2/3 of the excess return generated from those opportunities. So we are at this sort of center where investors tend to try to address these or target these opportunities, but they don't really get the full benefit from it. The reason why investors tend to lose out is basically threefold. Firstly, investors tend to invest too late. So they tend to invest after the theme has become mainstream, after the opportunity has sort of been appreciated by the market and some of these companies have become too expensive. The second thing is that investors tend to invest a bit too, let's say, naively. They tend to just invest into the theme without actually looking at if the individual companies are attractive or not, whether it be on a valuation basis or whether it be that they actually have the opportunities that they are claiming to have. The third one, which in my view is very important, but that tends to get forgotten when we talk about thematic opportunity, is around portfolio construction. So many of the investment funds out there that are trying to invest into thematic opportunities are doing it in a way that exposes their investors towards growth and quality. That can be really attractive, but when interest rates go up, or where you have these macro factors working against you, it gives you a very volatile performance. In reality, our view is that you can do that better if you apply traditional portfolio construction to how you manufacture these investment opportunities. So in our view, that's really important. And in that context, we've written this white paper around how to evaluate different thematic opportunities. We propose a framework consisting of 7 different parameters. If we take these parameters, it goes from both structural attractiveness and tactical attractiveness. And if we try to do this in the context of AI, we can think about, where is AI's investment opportunity actually placed relative to different opportunities. Firstly, we think about the structural attractiveness of a theme. That's usually where people start, and that's often also where people actually finish. People tend to just talk about and focus on what's the structural growth of this theme. That might be really important over the long term, but equally important, especially when it comes to multiples of companies, is also the extent to which that growth opportunity is actually accelerating or not. If you think about a 3 to 5 year investment horizon, structural growth is going to be really important, but the extent to which that structural opportunity is accelerating is going to be equally important in terms of the excess return that you're going to be able to deliver. If you think about this in the AI context, it's pretty clear that growth is accelerating, whether it be through data centers, whether it be through the application of AI software across the globe, that growth is accelerating and it's pretty attractive in our view. The issue is a lot of this growth is very far out into the future. And that comes into the second parameter on a structural attractiveness basis, and that's the extent to which there's investment risk associated with it. To which extent are you actually able to identify the winners of the AI revolution today? for some companies and in some areas, that's going to be pretty accurate, but in other areas, there's going to be pretty big question marks, especially when you take into account that there's not a company out there today that don't claim themselves that they are an AI winner. So in our view, you really need to do the fundamental work. You really need to go deep in terms of identifying what is the actual exposure, what is the actual value creation, which is going to come from that opportunity. It's not enough that you get growth, that it actually needs to be associated with value creation, and that's not equal from company to company. And then lastly, the size of the investment universe. When we think about this reason why investors tend to lose out on opportunities, a lot of it, again, comes down to this issue of portfolio construction. If you want to do proper portfolio construction, you need to have a significant investment universe so that you can diversify away some of those factor risk, lower the risk you didn't really want in the portfolio, and then you also need to have a significant enough bench so that when one company becomes too expensive, you can substitute that in with a different company. In our view, you have some of those characteristics in AI. There's plenty of opportunities if you don't just focus on the tech sector, but also go into the industrial sector, go into some of the other sectors as well, where you can find opportunities with exposure to, for example, data centers and similar. But you need to have that investment universe size for it to actually be attractive over the long term. The other things to consider, right, on the tactical space is the extent to which these companies are attractive from a pricing perspective. Are you actually overpaying for that growth? Are you overpaying for that value creation today? If we went back roughly 1.5 months ago, I would say there was parts of the AI investment opportunity where we thought that these companies were probably a little bit too expensive. There was equal amount of opportunities where we thought that these companies were actually pretty reasonably priced. One of the areas where we've seen a lot of reasonable priceness of the opportunity is, for example, in the hyperscalers. When you think about the risk that the market is right now perceiving and not really paying up for, it's this opportunity for hyperscalers to build up essentially what is a natural monopoly in the data center space for the next decade to be able to monopolize and commercialize the opportunity of AI. The reason why the market isn't paying up for this opportunity right now, whether it be the hyperscalers, is because there's a lot of upfront cost associated with building out data centers, and we've seen a significant rise in the capex budgets of these companies. But what that enables you to do when you are a hyperscaler with incredible pockets, it enables you to build a competitive position, which is going to be incredibly difficult for anybody else to actually replicate. And that means for decades to come, some of these hyperscalers are going to be in a very advantageous position to commercialize and to generate value from having that stronghold within the data center part of the supply chain. The last two parts here in the middle, whether it be factor risk or political risk, I think in this context, right, that is also something we tend to forget. Especially if there's factor risk associated with a investment theme, you need to be disproportionately compensated because it's very difficult to diversify away that factor risk. Especially when it comes to AI. AI is high growth, and for some of the companies, it's high quality as well. So if you invest into this theme, you are taking on additional risk that you need to be compensated for when it comes to these other parameters. If we go to the next page here, we try to take 6 different investment themes and we try to evaluate them based on these 7 different parameters. When we think about this in this context, AI comes out at a pretty attractive space, especially when it comes to sort of the structural attractiveness of the opportunity. But in reality, there are issues, especially as it pertains to the additional risk you're taking on from that additional factor risk. The way we try to integrate that into our portfolios is that for us, AI is a significant opportunity, but you need to do it in the context of a wider range of investment opportunities so that you can diversify away that additional risk that you're obtaining to it. So I'll show you guys later how we actually do that on an individual basis. But the takeaway here is that there's a significant opportunity when it comes to growth, and we'll go into details around how that manufactures itself for investment opportunities later. But the issue from a structural and tactical attractiveness part is the additional risk that you're taking on when you invest into something where there's high growth and then where there's high uncertainty about the future. I think that's a question.
Just a question.
Please.
Don't you think the AI topic is more like a horizontal, which stretches across across all the other bubbles that you have?
So that's a perfect segue into my next point, because that's actually one of the reasons why, when we think about agriculture and sustainable food, that's actually one of the areas where we see right now a rapid adoption of some of these digital technologies, some of these AI solutions, which is starting to flow into the agricultural and food space, but which at this point in time isn't really being priced by the market. So that's the sort of the next level of the AI revolution in our view. It's the sort of tech plus. So far, the market has mostly focused on AI, specifically in the tech sector. In our view, over the next 3 to 5 years, that growth opportunity is going to flow into different sectors instead when companies start to adopt this at a more significant scale. So far, the issue has been, from an adoption perspective, that there hasn't been enough computing capacity to actually train these models at a significant enough pace. If you look in the US data center space, for example, the utilization of US data centers is close to 100%, which means that it's incredibly expensive and incredibly difficult for companies to actually train their models and therefore apply them into the opportunities. But we see that significantly coming into the other areas as well, and we go into details about that later. So when we then try to go more into sort of the depths of what is actually the opportunities arising from the AI revolution, we've written this white paper together with our real asset investment team in principle, so the team that actually invests directly into data centers, to try and identify what are both the direct opportunities, but what are also the secondary opportunities, so the ones which are sort of, to some extent, a little bit forgotten by the market today. When we think about this from a direct opportunity perspective, we see a significant opportunity in terms of the rise and the growth of data centers towards 2030 and beyond. As I mentioned before, the utilization right now on data centers in the US is at 100%, close to 100%, around 99%. So it's actually, there's a bit of a bottleneck there in terms of the growth. There's more demand than there is supply. And if you think about Europe, for example, we are light years behind the build-out of data centers, and that is something which needs to be addressed, and something that let's say the regulators and politicians are trying to address. Because if you think about innovation power of an economy, your availability and your access to data center capacity is incredibly important for your opportunity as a country to take advantage of the rise of AI. The other opportunities we see here from a direct perspective is both in the tech sector, so think about the companies that are actually delivering chips into the data centers, but also companies that are delivering software into the data centers as well to make them run more efficiently. We see this very real opportunity for that, both in the short and the long term. We also see these AI use cases, which we'll exemplify with examples in the agricultural space later in this presentation. But that's just one of the areas where we see a significant rise in terms of the actual use cases and the applications of AI across different industries. We also see in the industrial sector, when you think about a data center being built, and when you think about data centers being built, it's actually around a third of the capex, a third of that investment, which is not flowing to chips, servers, and software. It's actually flowing directly into the industrial sector, whether it being cooling, whether it being electrical equipment. There's significant flow-through opportunities into other sectors there, which aren't really being valued today by the market. There's sort of the secondary opportunities, which we'll talk about later as well, is the fact that when we build all these data centers, all this infrastructure for the build-out of AI, it's massively energy consumption. If you think about a data center today, so a full-fledged data center that can run AI, the amount of electricity being used by that data center is roughly equivalent to 80,000 households, so around 160, 150,000 people. So if you think about that from an electricity consumption basis, you can either build a data center or you can build a new small town. It's a significant amount of additional electricity consumption being needed, and that's flowing through in terms of opportunities, both in the utility sector, building that electricity, but also into the supply chain behind it as well, which is sort of a new leg for the green transition. If you first go here to sort of the direct opportunities, one of the areas where we're already seeing a significant amount of growth, but we see a long longevity in terms of that growth, is within data centers. Data center growth from now until 2030 is roughly going to run around 20% CAGR. A lot of that growth is singularly going to the US, but in reality, Europe needs to invest as much, Asia needs to invest as much, LATAM needs to invest as much, and the rest of the world as well. So we see a very long growth trajectory towards 2030 and beyond for data centers, just to be able to run all these LLMs. So first you need to train the LLMs, you need to train the AI models, and then afterwards you need to run that model, which demands a significant amount of computer capacity. When we sum this up, we see that the growth opportunity in data centers specifically is roughly $1 trillion needed from an investment perspective over the next couple of years. So $1 trillion, which is roughly a doubling of the total amount of investment opportunity within data centers just over the next couple of years. That growth, that $1 trillion, is going to disproportionately benefit a lot of the tech companies, whether it be on chips, whether it be on software, whether it be on services, whether it be on innovative solutions to make chips more efficient. But ultimately, it's also going to flow into other industries, which we're going to talk about a bit before. So I mentioned that this opportunity in terms of data center and in terms of the growth in data centers is already pleasant. If we just take it, since 2019, the CapEx budgets for the big tech companies has roughly grown 330%. And in 2024, the growth in terms of CapEx into data centers grew by roughly 61% alone. So you're seeing that growth rate, really, really coming through. And it's actually not, it's not so much the supply, demand, which is setting the limitation. It's just around supply and the availability of equipment going into data centers. And that's a really advantageous position from a pricing perspective if you're one of the suppliers selling into these data centers. So that's an area where we see a lot of opportunity. The second part of the opportunity from data centers is this fact that 29%, so roughly 30% of the actual CapEx, so 29% of this $1 trillion is actually not going to flow into the tech companies, not the NVIDIAs, not any of these other companies. It's going to flow into traditional industrial companies. If you think about a data center today, it's a vast jungle of electrical equipment. All of that is basically, demanding a lot of electricity, which means that if you are a company that can lower the electricity consumption through more efficient electrical equipment, you're in a really advantageous position from being able to deliver efficiencies into these data centers. The limiting factor in many of the places of the world where you're trying to build data centers is actually not so much the demand for computing capacity from the end customer, is the availability of electricity. So if you are an industrial company which can be efficient in terms of electrical solutions, you can get a lot of growth opportunities from being a supplier into the data centers. Similarly, when you have this jungle of electrical equipment with chips using power, there's a lot of heat generation. And that is, that is creating a significant new investment opportunity for especially cooling companies, whether it be in terms of, HVAC, so basically air conditioning, or whether it be in terms of liquid cooling as well. We see a significant growth opportunity for some of these industrial companies that can deliver real solutions for cooling data centers in a more efficient way. It's around 40% of the OPEX, so 40% of the operational cost of a data center, which just comes from actually cooling the chips so that it can run at an efficient pace. So we see this rise of AI, giving significant opportunities in the tech sector, but also in the corresponding industrial sector as well. The last part in terms of these opportunities, in terms of the direct secondary opportunities, is within electricity consumption. I mentioned earlier that a new data center roughly demands as much electricity as around 80,000 households. When you think about this in the context of all the data centers we're trying to build in the world, if you just take that growth until the end of 2026, and if you then went to the end of 2026 and you took all these data centers across the world, and then you merge that into one country, that one country of data centers which would acquire as much electricity as Japan. That's completely insane. But if you think about what that means from an investor perspective, it means that first of all, if you can provide solutions to lower that electricity consumption on industrial scale from the industrials companies, that's very attractive. But if you think about it, at the end of the day, we're going to need a lot more power, because if we don't get that power, that electricity production, you're going to see prices rise, both in the US, but eventually also in Europe. So that means that you're starting to see these big tech companies actually becoming some of the biggest investors, some of the biggest financiers of especially renewable energy in the US. In the first 6 months of 2024 alone, the big tech companies in the US financed around 6 gigawatt of renewable capacity alone. They did the same thing in H2 as well, so roughly a run rate of around 12 gigawatt, only in the US of renewable energy being financed directly from the big tech companies. They're doing this because their OPEX is electricity. So if they don't build this renewable energy, if they don't build this gas as well to some extent, if they don't build that, the OPEX of running these data centers is going to be it's just going to be higher in the future because it's just going to be more expensive in terms of actually operating these. So you're seeing this vast inflow into the opportunity set for utilities. So the company is actually building these renewables and energy opportunities, but you're also seeing that flow through to the supply chain behind it. And that's pretty advantageous if you are, let's say, a green equipment manufacturer right now, where there's quite a bit of uncertainty in terms of your growth rates in the US, then it's quite pleasant that you actually have something which is not related to regulatory uncertainty, but where it's actually economics which is driving the demand, which is the case for the big tech companies right now investing into the into the renewable sector. I mentioned earlier that so far the opportunity set in AI has very much been centered around tech companies, to some extent some of the industrial companies, but it's very much sort of the direct beneficiaries and what we can see today. Our view is that over the next 5 years and beyond, you're going to see a significant rise of opportunities from AI being applied into other sectors as well. That's going to be quite important from a growth perspective, because if you are a company that can sell more efficient solutions, if you are a company which can sell AI-enabled solutions that actually delivers a real opportunity set at the end of the day, you're going to be in an advantageous position from delivering value. Especially when you think about that when you sell something which is software, it used to be, it's usually a lot more attractive than what you otherwise sell, right? Because software tends to be higher margin and lower capital intensity. If you think about this in the context of sectors where we see a significant opportunity, and especially where we see that opportunity not being priced today, the rise of AI and digitalization in agriculture is one of the areas that we are most excited about. So agriculture, so I grew up on a farm, so I know that by heart, used to probably be one of the least digitalized and probably one of the most boring industries when it comes to the sort of the adoption of technology in the world. It used to be that it was just a farmer running around with pretty heavy equipment. There wasn't really that much technology being applied, but all of that, especially over the last 3 years, has started to change. It started to change because you're seeing a lot of those technologies that have been applied in other industries starting to be introduced into the agricultural sector as well. One of the areas that we are very excited about is within precision agriculture. So precision agriculture essentially is the application of technology to make agricultural equipment more efficient. If you take one example, for example, a spray of herbicides. In the past, when a farmer was treating a piece of land, he would treat the whole land unanimously. So he would spray the whole land, he would apply fertilizer on the whole land. All of that had significant cost from a farmer perspective, because you're not really getting the benefit where you need it, you're just spraying everything in the same way. If you think about this from a sustainability perspective as well, when you apply fertilizers or herbicides on everything, and not just specifically where it's needed, there's also significant biodiversity and negative impact from that as well. We see this as one of the areas where it's starting to change quite a bit. If you go and see the most advanced equipment right now in sprayer technology, for example, so if you see a sprayer today where you used to spray everything with herbicides, the most advanced ones there today have cameras on them. Those cameras actually have NVIDIA chips in them. And then those cameras can then spray at the blink of an eye. Then they can identify what is a weed and what is a crop. And then that camera then tells the sprayer, spray that, don't spray that. That can actually lower the amount of herbicides being used by around 70 to 80%. That's a significant benefit for the farmer, right? Because he's actually saving quite a bit in terms of the herbicides he uses, but it's also significant saving for the environment, because the herbicides not being used, used to just be drained down into the waterways, which would have a negative, biodiversity impact. So this is one of the areas where we're seeing a significant opportunity from an investor perspective, because if the farmer can save 70 to 80%, he's very willing to pay for that. But at the same time as well, from a sustainability perspective, we're also seeing a significant incremental positive advantage from a lower biodiversity impact. If you think about this from an investment opportunity perspective, it's great that farmers are willing to pay because that accelerates the growth. But again, when you are an equipment provider where you usually just sold a heavy piece of equipment, that heavy piece of equipment used to be pretty capex heavy, and you didn't really have a margin that was that attractive either. When you think about this in the concept of selling a software-enabled, AI-enabled piece of equipment, you're selling that software part with a much better margin. You're selling it with an ability to price it not just when you sell it, but also for software upgrades and so on. So you get a revenue stream which is much longer. And then you get a capital intensity which is significantly lower as well. So if you, for example, take one of the leading companies in the US in this area, which is John Deere, they used to roughly spend 5% of their revenues on capex. Now that's down below 2%. So significant less capital bound in terms of their investment because they're selling software-enabled solutions rather than just selling heavy equipment. For us, that's a really attractive opportunity, and it's one which isn't really, on a broad scale being priced by the market because there's still a couple of years out there before you see that really accelerate, although in precision agriculture, it is starting to actually have an impact on the financials, which is really attractive. Please. So the entry cost from our perspective, so it's actually relatively easy barrier for the farmer because he's anyway paying for that sprayer or that piece of equipment. The way that some of these companies are trying to price it is that you pay the same, but then you pay an ongoing cost afterwards for the efficiency.
AI companies as well. Right?
So from an AI company, right, you are the one that is then, delivering the solution from a chips perspective because some of these, equipments require quite a lot of, chips. But if you think about that sort of tech plus, so the opportunity for for AI not just to be an opportunity for AI companies or tech companies, that's one of the things that we see most attractive is when that growth and that opportunity set starts to mushroom out or amplify out into other industries as well. And from an investor perspective, that's pretty attractive, right? Because that's not really being priced today. So you don't really see it in the share price today. But once that growth starts to accelerate, you get more of that pricing in terms of it from an investor perspective. Yeah. So this sort of precision agriculture is already an investment opportunity today, but we see a long sort of tailwind for these opportunities to start a mushroom up and get opportunities across the field. One of the areas, just to stay in the agricultural arena, where we're starting to see in early stages being adopted as well, is within drone technology. So already today, a lot of the farmers have drones which can sort of give them a little bit of data in terms of how the fields are actually being, are actually growing and how they're actually doing. But we see this being accelerated significantly in the future. If you think about the application of vision technology from a drone perspective, and that drone can then fly over the field and take individual pictures of the plants on the different sectors, then that drone can then tell you if one of those plants is starting to look rough, if one of those plants is starting to look sick, and you can then actually identify that before that disease starts to spread to the other plants. So you get a much more early adoption base, but you also get that drone then taking that picture, benchmarking it to a wealth of different pictures from around the world, and then the farmer can then get access to what is the best practice for then dealing with this issue on that specific plant. So that sort of opportunity can lead to significant yield improvements in terms of the output from a farmer perspective on the fields, and that's again something that we're seeing farmers, especially advanced farmers, starting to really be willing to pay for because it can actually give them really improvements in terms of the yield efficiency. From a sustainability perspective, that's going to be really important as well, right? Because we're looking into a world where we are today around 8 billion people. If you think about 2050, we're going to be around 10 billion people. We don't really have that much additional cropland to be able to grow more resources. So the only way we're actually going to be able to feed those people in the future without having a negative biodiversity impact is by actually being able to grow more food with a lower environmental impact. If you think about that 2 billion additional people, and you combine that with the fact that people are moving up the income pyramid, that means that by 2050, we will need around 56% more food. So from an investor perspective, we see this area in terms of agriculture and biodiversity as a significant opportunity because you're getting this adoption from a innovation perspective, but you also have a world where you really need that innovation to actually be applied, and that means that regulation as well is pushing farmers to actually adopt more sustainable farming practices. Just a couple of notes here before we go to real Q&A, or to the rest of the Q&A. So for us, AI is a really big opportunity. It's a really big opportunity on itself, but as I talked about in the beginning, the issue if you just invest specifically and only into AI is that you do get some factor risk, and then you do also get some risk in relation to that your investment universe is, it has some size, but it does narrow your investment opportunity set quite significantly, which means that you are also getting additional investment risk when it comes to identifying these opportunities. So for us instead, we pursue this in a portfolio context. We like this notion of having the opportunity set, but not getting the additional risk. And the only way you're going to be able to do that is if you apply proper portfolio construction. We do this, for example, in our sustainable equity strategy. We see that if we want a sustainable transition, you need AI because that's going to enable a lot of the technology needed. But if you want AI without having a negative environmental impact, you need to make the electricity green. You need to actually lower the amount of electricity needed in data centers. And you're going to have a lot of companies coming up with innovative solutions to be able to do that. And that's some of the things we're trying to target in our sustainable equity strategy. In the strategy here, which is the global equity strategy, we have 3 areas of investment opportunities that we are targeting. The first one being natural capital and biodiversity. In biodiversity, as it pertains to AI, we see quite a bit of opportunities within the sort of sustainable food segment. So the opportunity sets are rising from adopting this AI technology, adopting this digitalization, and then providing more efficient ways of actually producing more food with a lower environmental impact. We see this as sort of the opportunity to address this tech plus opportunity. The fact that right now the market is mostly focused on the tech sector, but in reality, over the next 3 to 5 years, those opportunities are going to flow into different sectors as well. And we see a wealth of opportunities in this sustainable food and agricultural area. The other area which we have quite a bit of exposure to and are very excited about is within climate solutions. And climate solutions, as it pertains to AI, is the companies that are able to make the transition into AI more efficient from an electricity consumption perspective, and therefore greenify or make the transition more green. In this area, we are invested in some of the utility companies that are actually the companies building the green energy for the data centers out there. These green energy companies, whether it be Iberdrola and SSE, are companies that have expertise within green energy. It's companies that have a system of different green solutions. So they both have solar, they have wind, they have battery technology, which means that when they go out and sign what is called a corporate PPA, which is the agreement between the utility to deliver green power, they can do that from a wealth of different, green power, sites, which means that they can guarantee that the power is actually green. The other area where we have quite a bit of exposure is within energy efficiency. This is an area where we are, pretty excited, both from a energy efficiency of buildings, but when you think about energy efficiency of data centers, with that massive amount of electricity being needed in the future, that's an area where we're seeing that very much being priced, but it's also an area where we're seeing a lot of growth, because again, the OPEX of the data center hyperscalers is basically electricity. So they want to lower that OPEX, and they can do that through a lower amount of electricity being used. The last part of it is within this sort of green AI infrastructure. When you think about AI and the application of AI in data centers, you need, innovative solutions to just be able to architecture and design the sort of, the structure of the data centers in a more efficient way as well. One of the areas that we're quite excited about in this place is what is called system on a chip. So usually, right, if you had a stack of chips operating, you would maybe have 10 chips, and all of those chips would individually be operating by themselves. In reality, if you instead apply a system on a chip approach, you can stack those chips on each other through the application of software, which means that the chips becomes much more efficient from an energy perspective, and that can lower the amount of energy being used, and therefore also the amount of negative impact at the end of the day. With that, I think we'll transition into Q&A. Yeah, so this is just examples of the opportunities in there. So there's a couple of other ones which we haven't listed on this one, but keen eye.
Works.
Yeah, please.
Okay. So, Martin, I remember in the very beginning of the presentation, you mentioned hyperscalers in AI, right?
Yes.
What would be the top 2, 3 that you see being becoming the biggest hyperscalers?
Yeah, so we're seeing, a lot of the tech companies becoming sort of, the big investors from a data center perspective. I think, in my view, the market tends to treat them quite, unanimously, whether it be Microsoft, whether it be, Amazon, whether it be Google. I think from an investor perspective, in my view, you need to look more in terms of what is the actual individual components of their data center and cloud, offering, right? If you think about, cloud as an investment opportunity, if you think about that from an investor perspective, it's very different if you are in warehouse cloud, so basically where you're just storing data at your cloud provider, relative to if you're, for example, buying more analytics from that, hyperscaler. If you think about, Azure, for example, from Microsoft, a lot of that and a lot of the revenue they generate there is more geared towards analytics, so actually AI analytics. Amazon is trying, and with their AWS, is trying to get a stronger hold on that as well, but their traditional stronghold was always in that sort of warehouse, warehousing of data, capacity, which is also attractive. But the issue with that market is that, it tends to grow, around 20%, 15-20%. But the reason why it grows 15-20% is because the data is growing by around 40%, but then the price of that data is falling by around 20% per year. So you basically have to run quite fast, not to stand still. While if you think about analytics, for example, and if you're disproportionately exposed towards analytics, you can use AI to deliver even more impact to your customers and therefore also sell more value to your customers, which in our view, is a more attractive part of that sort of, cloud capacity perspective.
So you've talked about data center and,
Yes.
and agriculture. I do agree on the agriculture side, and implicitly you've given us a short recommendation there to go short fertilizing companies. But on the data center, there has been some recent talk about data center bubbles.
Yes.
I think Microsoft pulled out of a large, or it's not confirmed, but it's been rumored that they pulled out of a large lease, and so have others. So how this is sort of, you've taken a very bullish approach on that sector. How much of this is already built? How much of this capex is sustainable? And how much risk is there? Because as we've seen with DeepSeek and maybe other disruptors that we don't even know yet, there might be not such a demand as currently forecasted.
Yeah, so DeepSeek was sort of let's say the point in which the market really started to question this exceptional growth in capex by the big tech companies, and therefore also the corresponding growth in the data center market, right? So as we saw earlier, the growth in terms of capex from these companies have roughly grown by 330% since 2019. So it's very reasonable for investors to actually ask the question: what is the ROI? What is the return on investment you're actually getting from that opportunity? When you think about this in the context of DeepSeek, for example, in our view, that is what you would normally see in an early stage technology. If you look in terms of the innovation curve and the efficiency curve in terms of how models are trained, it's actually not that far off relative to where the innovation curve and the efficiency curve of the past has been. It's just when you see that sort of maturing in terms, especially in terms of the training part of it, it was a step change, but it wasn't a material step change relative to what you've seen in the past. You'd already seen that step change happen multiple times. So it was, in our view, it was a little bit overblown from a, this is the end of the need for computing capacity, especially when you think about the fact that, the total amount of data centers being used right now in the US is running at, at 100%. Or 99%. So basically, you need more data centers than there are available today. And also the fact that if you look in terms of what are those data centers actually doing, most of the data center capacity from a computing perspective is actually not so much training the models, it's running the models afterwards. The issue so far has been that there hasn't been enough computing capacity out there to train the models at a reasonable cost. So if you were to get that innovation, that efficiency in terms of being able to train models faster, you would then get that huge backlog of models out there that the companies want to train. You would be able to actually push them through faster, which also means that the need for actually running those models in data centers afterwards would be higher than what it is today. So in our view, part of that risk is justified because anytime you have some, technology which is, so new and innovative, there is going to be step changes, and a lot we don't know today. That goes back to my point earlier that if you just invest into AI as one specific investment theme, you are exposing yourself to investment risk. But if instead you are doing it in a portfolio context where you can do that together with other investment opportunities as well, you are gaining that investment opportunity, but you're not necessarily paying for it with the same risk because you're doing portfolio construction to diversify part of that away. So long story short, in our view, the investments make sense because when you are a big tech company today making those investments, you are building what is essentially a natural monopoly when it comes to the actual commercialization in terms of running AI models in the future. And the tech companies there have already been very successful in terms of doing that in the cloud transition in the past. So we see some resemblance in terms of that revolution. When you think about the let's say the risk reward of taking specific investment opportunities when it comes to specific companies developing one specific LLM, that cost of innovation of developing LLMs is definitely going to go down. So that also means your barriers to entry if you're a software company with one specific AI model, that risk return is probably a little bit worse than it was in the past because the cost of innovation is going down. So in our view, you need to be selective in terms of where you actually take that AI opportunity risk. Yeah, definitely. So in this strategy, this is a sustainable Article 9 strategy. So all of our companies need to be, linked towards having a real-world impact at the end of the day. When you think about how we've actually constructed these, these themes and these investment opportunities, in this strategy specifically, we target AI, but we also need to have a positive impact at the same time. The way we've done that is that we have identified 7 of the 17 SDGs, which are actually investable by companies. It means that it's actually SDGs where companies can deliver solutions towards issues from a sustainability perspective, and then they're actually able to sell those solutions at the end of the day as well. So we've been through these 7 SDGs, and then we've tried to identify what opportunities are actually there and what solutions are actually required. We did that through using our fundamental investment analyst. We have around 11 analysts with around 19 years of average experience. So very advanced, very sort of, experienced individual with a lot of knowledge. And then we try to identify if you, for example, want to create zero hunger in the world, if you want to feed the world in a sustainable way, what solutions are required? You need precision agriculture. You need meat alternatives. You need, sustainable food packaging as well, so you can lower the amount of food waste in the world. And all of these opportunities are opportunities where there's a real investment opportunity, but also where there's a real sustainability impact opportunity at the end of the day. We then took all of these, solutions, and then we morphed that into an AI-enabled textual analytics tool. We've actually recently won an award for the best application of AI in investment process through this work. And that's sort of how we create our investment universe within our strategy. From that investment universe, we then source our companies that goes into the strategy, and we set specific requirements for what they have to be able to deliver from an impact perspective for them to actually be deemed sustainable. First of all, they need to have a significant amount of their revenues, which is actually aligned with delivering these solutions towards the UN SDGs. We do that on an individual basis, which means we go in and evaluate every single part of their operations and their revenues to go through what is actually aligned with the UN SDGs and what is not, and then we do that on a net basis. Thirdly, we go in and set what we call key SDG contribution points. Think about these as explicit targets that we set for the company that it needs to be able to deliver in the future for it to have a significant amount of impact on the UN SDGs. And then, of course, we follow through on our focused engagement to make sure that there actually is a follow-through from the companies in the end, and that the companies actually have a real-world impact. Please.
You've mentioned the huge demand for electricity in the future. Can this demand be met with renewable energy only?
So it's a good question in that context. If you think about the growth needed in the total amount of renewables in the world to accommodate this growth over the next 2 years, you would have to grow the amount of total renewables in the world by roughly 16%. So it is a significant additional driver in terms of additional, but that's just the next 2 years. So you need that again 2 years after, and 2 years after, and 2 years after. So it would be a significant amount of additional renewable energy needed. The issue, of course, with renewable energy is that it's intermittent, which means that it's dependent upon natural sources. So for this to be at a grand scale, you would need some level of actually storage as well, and it would need to probably work together with additional potentially gas or other sort of technologies. What we're seeing, which is pretty exciting as well, is again, the OPEX of these companies, especially the big tech companies, is electricity. So the extent to which that they can use electricity at the time where it's most cheap is a very big beneficiary for them. So they're actually also applying AI to be able to better forecast where is the computing need, so the electricity need associated with that computing, and where is the cost of electricity cheapest within their own ecosystem. So if you think about a company in the US that has data centers all over the US, if you think about where they're actually going to run that computing capacity, they're going to do that in an efficient way in terms of where the electricity is the cheapest. So in a way, AI is also helping that meeting of computing capacity and electricity availability at the end of the day. So I think you need significant innovations to actually be able to get it to a grand scale, especially when it comes to storage. But there are also other ways, again, in terms of making it more efficient along the way. So it's probably going to be a bit of a combination. And you are also starting to see some of the tech companies, at least commit themselves to off-taking power from small nuclear reactors. That's 2035 and beyond. And then you're starting to see some of them also invest into gas, but gas with carbon capture and storage at the same time. I think it's going to play a pretty big role, to be honest, especially because you've seen the cost curve on battery technology continue to come down. You've seen just in the last few years, battery technology cost going down by around 60%. And a lot of that battery cost is, again, just associated with scaling up this the sort of the industrialization of the production of technologies of batteries, because it's relatively easy to actually produce batteries. I think the big swing factor, which will be the big question as well, is to what role is green hydrogen actually going to be able to achieve the cost point needed to be competitive? Because green hydrogen is a very efficient way to store large amounts of electricity. It's difficult because it's quite expensive. But if you can get that breakthrough in terms of the cost, which you can get from industrialization and more efficient ways of converting energy from electrical energy into chemical energy in the electrolyzers, to that extent, if you can get that, then it's a very nice way of actually being able to store a large amount of electricity for a very long period of time, and that would also be very beneficial in that context. I think that was all the time we had, but thanks a lot for the questions and interest.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.